Was the Walt Disney Company earnings call really as good as some folks out there think it was? Well, if we do a hot take on merely the aftermarket trading that occurred during the earnings call, and then, of course, the full day of trading following the earnings call on Thursday, February 8th, you could look at this chart and think, wow, everything's spectacular. But let me bring some reality into the mix and ask folks, wait for the dust to settle. Because I think there were a lot of big red flags that were in that earnings report, and we need to cover it now in more detail. Because as of right now, there doesn't seem to be much, if any, indication by Bob Iger and the Walt Disney Company that a lot of the internal rot and problems at Disney are going to get fixed. And that's something that people better take sharp note of. Renegade Online. Well, folks, welcome back. Another great day here at Valiant Renegade. It's good to see everybody out there once again. And if you are like one of the many folks watching this video, not yet subscribed to this channel, please take a moment and turn that little red subscribe button to gray. Hit that like button, hit that notification bell, share this sucker out on the social medias, and of course, please do leave a comment before you head out the door today. Make sure to join us every Sunday afternoon right here on Valiant Renegade for the live show at 6 p.m. Eastern. There was much jubilation during the Disney earnings call as Bob Iger announced such wonderful things as a $1.5 billion partnership with Epic Games and Fortnite. Or how about Taylor Swift and her Eras Tour coming exclusively in a pay-one window to Disney+. We even got news of a giant new sports conglomerate between Warner Brothers, Fox, and Disney. All of that is wonderful news. However, there were a tremendous number of questions left unanswered and a lot of very concerning data that was seemingly glossed over. Disney's core properties have been suffering. That is, properties they've had now for a decade or more. Things like Marvel, Star Wars, Lucasfilm, Walt Disney Animation, Pixar, just to name a few. Or how about merchandising, content, and licensing? Or what about the big cash cow, the top-line revenue driver and profit maker for the Walt Disney Company, Parks and Resorts? Well, if we look at the actual earnings report itself, we start finding a bit more clarity on things behind all of the pixie dust and glitter that Bob Iger sprinkled on the Wall Street elite on Wednesday, February 7th. The report states revenues for the quarter were comparable to the prior year quarter at $23.5 billion, but yet earnings per share increased from 99 cents a year ago to $1.22 this year. Now, that earnings beat made Wall Street very happy, but if we dig in deeper, it's more about what Disney cut than what Disney grew. Now, that's not a bad thing, and I want to make that very clear. A lot of companies do have to make tremendous cost cuts to turn their books around. We've seen that with Warner Brothers Discovery in the past couple of years. But at some point, growth has to take over. And with Disney, I'm not sure where that's coming from, at least from their existing core business. Disney says they're on track to meet or exceed the $7.5 billion annualized savings target by the end of fiscal 2024, while they continue to look for further efficiency opportunities. Strangely, however, in those key points, they don't seem to mention much about what a big growth driver is. Now, they're expecting, or at least suggesting, that they now believe that DTC, or more specifically Disney Plus in combination with Hulu, could be a driving force for growth in revenue down the road, but no promises yet, of course. Let's look at the entertainment division first, which had a total overall decrease of 7%. Again, this is a major core area for Disney. This is linear cable networks or broadcast television networks. It's direct-to-consumer like Disney Plus and Hulu. Content, sales, licensing, and other. Hey, that's the stuff that's going to the movie theaters or Disney licenses out to third parties. Linear networks declined in total revenue 12%. Now, that's not terribly off the mark compared to the rest of the industry. Because why? People are cutting the cord. They're moving to streaming. So we should start seeing increases in streaming revenue and profitability. Now, Disney does show that with direct-to-consumer to some degree, with a 15% increase year over year. in the streaming services. Strictly speaking, Hulu and Disney Plus. ESPN Plus is in the sports division now. But content sales and licensing, the big movies and third-party licensing for television shows, took a massive 38% kick in the teeth. But what does revenue even mean without understanding what did they actually make? What was the profit on that revenue? Well, in linear networks, that too went down 7%. But look at direct-to-consumer. That narrowed. But did it really narrow because of a growth in top-line revenue? Or did it narrow because Disney decided to slash the budgets and the spending on places like Disney Plus? Was there also an impact here because, well, Disney wasn't spending anything on production during the quarter because of the actors and writers strikes? A lot of those costs tend to be lagging, meaning you won't see the actual expenses taken for several months or maybe quarters later. But what I suspect what we're seeing here is some of the impact of things not being produced that started 3 to 6 months before this earnings report. But look at content sales and licensing. Again, the profitability of primarily theatrical distribution, or one of the primary components. Disney bragged about how in the previous year, hey, you know what? We had Avatar. We had Wakanda Forever in that quarter. They still lost $1 million on theatrical distribution in the quarter that Avatar and Wakanda came out. What does that tell you? It's like we've said before, James Cameron still takes home the lion's share of profits on Avatar. Disney gets a distribution fee, and Disney has to pay to advertise the movie into theaters. Wakanda Forever didn't really make much money, or may not have made any at all. And then, of course, during that same quarter, I believe you had another flop called Strange World. But look at the quarter that just passed. A loss of $224 million. That is due overwhelmingly to the failure of The Marvels and Wish. Don't believe me? Read Disney's words right there in their own report for yourself. Now let's look at Disney Plus, which quite frankly has been one of the biggest driving factors on Disney's stock performance since the service was announced and then launched in late 2019. Disney Plus lost another 400,000 North American subscribers, their most core of core markets. And if we look at overall Disney Plus core, they dropped 1.3 million subs. That's basically everything that is Disney Plus outside of Hotstar in India. While Disney picked up 1.2 million subs in Hulu, Disney Plus core subscribers decreased, according to them, in line with prior guidance and reflected a substantial price increase in the quarter as well. Hulu, Disney Plus, and ESPN Plus all got price increases during that fiscal quarter. How then did Hulu pick up 1.2 million subs and Disney Plus lose 1.3 million subs, and we're expected to believe that the price increase had an impact on those subs alone? I'm wondering if it doesn't just have something to do with the fact that Disney Plus is not actually producing content that is engaging viewers long enough to stick around. When your biggest thing on Disney Plus is a property that you don't even make, namely Bluey, that's going to catch up with you. And yes, you'll get some classic library flashes in the pan, like re-releasing Moana onto Disney Plus, and it became a big hit. But that's not going to sustain you very long. As a reminder, everybody had price increases last year across the board, at least for the major players, including Netflix and Warner Brothers' own Max service. So how then, in the very same calendar quarter between October 1st and December 31st, when both the Walt Disney Company and Netflix raised all of their subscription fees, did Disney suggest that the increase in prices lost them 1.3 million subscribers, while Netflix picked up 13 million? Now, Disney suggests that they're going to start engaging in their password crackdown sharing, and some of that may have to do with what Disney guided forward with, suggesting that they would add 5 to 6 million new subscribers to Disney Plus during the current fiscal quarter, the one running right now from January 1st to March 31st. They'll report on that one sometime in early May. It could also have to do with the fact that Disney has brought in this. Bringing in Taylor Swift's Eras Tour and the exclusive streaming rights is probably something that Bob Iger is figuring that is going to bring in millions of new subscribers all on its own. But here's a little trick that Disney pulled. You see, the Eras Tour movie coming to Disney Plus is going to drop on March 15th. That's right, about 2 weeks before the end of the fiscal quarter for Disney. That means if 5 million new subscribers sign up just to watch Taylor Swift and then drop the service a month or two later, we won't know about it for about another 6 months. You see, all those subscribers by the end of the fiscal quarter, if they just signed up in March, wouldn't have even gotten their second billing statement yet. That means if they cancel their Disney Plus subscription just 30 days later, we're not going to find out about that until the earnings report that's sometime in August. But Bob Iger will be able to go onto the May earnings call touting this massive increase in new Disney Plus subs that by that point may not still be there. And don't forget this big news. For 14 million Spectrum customers with basic cable, they're now going to have Disney Plus as part of their package. How many subscriptions are going to be maybe duplicated for a short period of time as people may be unsigning from their previous Disney Plus subscription and signing up through Spectrum instead of paying Disney directly? We just don't know. There's really been no guidance on how they're going to actually report these types of numbers. Is the revenue from Spectrum related to Disney Plus going to come in as something of a linear network revenue, or is that revenue going to be attributed to Disney Plus itself?
Don't know.
The jury's still out on that, but these are questions that need to be answered. Experiences is the big section for the Walt Disney Company. This now encompasses, as you can see, parks and experiences, which is all the Disney theme parks around the world, along with all of their resorts, the Disney Vacation Club, the hotel properties, along with things like consumer products, the merchandise, the licensing revenue that Disney receives from partners like Hasbro and Mattel and countless others for manufacturing and selling Disney IPs as toys or t-shirts or sleeping bags and everything else you can imagine. Now, consumer products saw about the same revenue they had the previous year, down about 1%, but a 4% increase in overall operating income, or at least that measure of profitability, many times referred to as EBITDA, earnings before interest, taxes, depreciation, and amortization. But look at Disney's own words for the consumer products. The increase in consumer products operating results was due to licensing revenue growth resulting from higher sales of products based on Spider-Man and Mickey and Friends. Spider-Man, not Marvel as a whole, but specifically Spider-Man. And the reason that's broken out is because Spider-Man is held separately apart from the rest of Marvel, mainly due to the co-licensing relationship they have with Sony. But then the coup de grace, we've got the fact that this was partially offset by a decrease in sales of products based on Star Wars. Yep, Star Wars, specifically named. Now, if you remember several earnings calls ago, we pointed out in a previous report from about sometime in 2022 or early 23 that Disney specifically carved out classic Star Wars as a big seller for them that overperformed not all of Star Wars, but classic Star Wars, George Lucas Star Wars. Now it seems that Star Wars as a whole, as we've told you for months, was on the decline in the merchandise sales, and now Disney has admitted it in their own earnings report. And what's Disney's answer? A Mandalorian movie. Why? Well, because movies sell more toys than TV shows. And as we've stated before, rumor has it that a lot of their merchandising partners have been clamoring Disney to get Star Wars back into theaters because they're suffering. They can't sell their licensed Star Wars toys like they used to. Licenses that cost their partners millions, tens of millions, hundreds of millions of dollars over time that they have to pay back to Disney to make the products that, frankly, in this case, are not selling. But now let's look at parks. That's the big thing, right? Parks and experiences. A modest 4% increase year over year, which you would expect at least that much with the inflationary pressures that we had over the past 12 months. But looking at the operating income, the measure of profitability, it's actually down 2%. Disney attributes this to a decrease at Walt Disney World Resort. That's the big Orlando park, reflecting a modest decrease in revenues and higher costs. Lower volumes were due to decreases in attendance and occupied room nights, both of which reflected the comparison to the 50th anniversary celebration in the prior year quarter. Higher costs due to inflation, increased guest spending due to higher average ticket prices, offset by lower average daily room rates. If anybody wants a simple example, look no further than the Galactic Star Cruiser. It's closed. Now, to be fair, Universal's Orlando Park also had a bit of a down year compared to the year before, but it doesn't seem to have been as much as the Walt Disney Company. And of course, the big thing, the forward guidance here that I would give, or at least request Disney to give us, is what are they going to do about the massive competition that is going to likely stomp them next year in 2025 when Epic Universe opens. There was even somebody during the Disney earnings call asking Bob Iger about opening a fifth gate in Orlando, to which there wasn't too much of a response there. See, Disney doesn't seem to want to spend anything in Florida right now. They're spending billions of dollars, or at least they plan to, overseas in their international parks during the next 10 years, as they previously stated. They seem to be walking away from Orlando, and for some reason, Wall Street just seems to ignore this. If Disney is going to simply sit there and watch as Universal Studios and Comcast take the Orlando crown, the crown of all crowns when it comes to theme parks, well, that's on them. There's a lot to unpack in here, but please go ahead, check out their website and read it for yourself. But hey, check out the stock price right now. Bob Iger and the Walt Disney Company arguably did their job on Wednesday, February 7th, and satiated investor fears, at least for now. And more importantly, may have put a bit more distance between Bob Iger's slate of Walt Disney Company board nominees and those from proxies and activist investors like Nelson Peltz and Trian, and who knows, maybe even Elon Musk. The question is, how long will that really hold up? At what point does the rubber meet the road? Is this a legitimate long-term new growth pattern for Disney stock? I don't know. I'm not here to talk about that. Was all of that upward momentum just from the jubilation of the earnings call? Or was it maybe a metric ton of Disney stock options that were floating out there that had roughly $100 strike prices that all turned into a massive automated trading cascade effect? I don't know, but I mean, hey, it's out there. That's where it is. We'll find out in the next few days and weeks if this new momentum for Disney, at least insofar as what investors think it's worth, is going to hold. Or will the next big box office or Disney Plus flop bring it right back down to earth? But no matter what Bob Iger and Disney do or say at this point, or the Disney stock price for that matter, Nelson Peltz and his friends like Ike Perlmutter, Jay Rassolo, and now, apparently, Elon Musk, are not going away anytime soon. They're looking forward towards the April shareholder meeting, which we'll be covering live here. Stay tuned for that. But let me know your thoughts. And until next time, take care. Make sure you're subscribed to Valiant Renegade and join us every Sunday at 6 p.m. Eastern for the live show.